Momentum investing can be effective, it can be profitable, it has its benefits, but all the same, it equally possesses a number of pitfalls. And that is what I want to examine in this video. So here are some common issues to watch out for as an intending or an aspiring momentum investor. Number one is volatility. Volatility. Momentum strategies can be highly volatile with rapid price swings that might lead to significant losses if trends reverse unexpectedly. As I earlier discussed in one of my videos, momentum investing is a trend based investing. You wait for the trend to start to take off, and once an upward trend takes off, you buy the stock concern. But this particular trend could be subject to volatility. If the trend is going up, fine. But when it starts fluctuating, when it drops all of a sudden, each step in the drop of the stock price signifies a drop in your investment value. And it might come to a point that the drop will be so much, it will affect your portfolio, will affect your investment negatively. So the volatility is something you must consider because an uptrend will not last forever. It would likely, drop, become a downtrend in the no distant time than when you purchase the stock. Number two, trend reversals. Trend reversals. Momentum investing relies on the condition of trends. Is told us earlier is simply a trend-based strategy. So if trends reverse suddenly, it can lead to a sharp decline in the value of the assets or a sharp decline in the value of your investment. In other words, you may sustain either paper losses or even a real loss as a result. Number three, market timing. Market timing. So accurately timing the entry and exit points can be challenging. All right, you fully establish a trend that the trend is occurring or is about to occur. Well, it might be very difficult to predict precisely, when a trend is about to begin. And not only that, it's equally very difficult to predict when a trend will end, when an uptrend will eventually will reverse into a downtrend. So that particular timing is something that is quite difficult to be able to ascertain. And so if you are not very, very accurate with that timing, it might lead into eventual loss because poor timing can lead to losses even if the overall strategy is a very sound one, is profitable, it's applicable. But if the timing is wrong, you may end up still incurring losses. Number five, short-term focus. Short-term focus. The strategy often emphasizes short-term gains, which might lead to neglecting long-term investment goals and fundamentals. When it comes to momentum investing, you know, the people concerned actually, are so much concerned about you know about timing, not necessarily about the company's fundamentals. No, they are so bothered about timing the trend, when to enter and when to exit. And this particular timing leads to a kind of short-term mentality, in the markets. And they don't really bother much about the company fundamentals. They don't really bother about the company doing fine in the long run. They are so much concerned about when the trend is starting and when the trend is ending. Another point here is over trading. Over trading. Momentum investing may involve frequent trading, which we all know, can lead to a higher transaction cost and the potential tax implication is very high because of the short-term profit accumulated that will equally attract a higher level of task, capital gain task. The shorter the length of time before you sell an investment, the higher the tax implication. The longer your holding period before you eventually sell, the lower the tax involved. The next point is crowded threats. Crowded threats. If many investors follow the same momentum signal, it can lead to overcrowded threats, where price becomes inflated and more susceptible to correction. You should not forget that because when it comes to this particular strategy, you are not the only investor, the only individual that have taken note of the trend. And so once everybody gets to know about the trend, people will now pile in, investors will now pile in, buying the same stocks, riding the trend. And by so doing, the trend becomes overcrowded. And once it becomes overcrowded, the price will be inflated. The stock becomes overpriced, and within a certain period of time, it will get corrected by the market, and that correction will bring about a sharp drop in price. And a sharp drop in price of the assets of the security of the stocks will invariably lead to losses depending on when you key into the trend. The next point is data overload. Data overload. Relying on technical indicators and data can sometimes lead to over analysis. In other words, it leads to analysis by paralysis. Paralysis by analysis, so to say, and or over complicating decision making. It makes the entire process very complicated because of loads of data you are expected to analyze and rely on that is expected to form a backbone of your investment decision making. And so it's always that tendency that you become overloaded with data, you become, over informed, so to say, you become paralyzed because of excess analysis. We should take that into consideration. And then the next point is behavioral biases. Behavioral biases. Investors may be influenced by their own biases, such as chasing recent performance or what is called recency bias, or ignoring warning signs due to overconfidence. You know, the stock is getting overpriced, and then you are still holding it because you believe it will continue going higher. You know, and then before you understand, overconfidence kicks in, and before you know what is happening, the stock gets corrected. Invariably there's a correction in the market, and the price will then sharply drop as a result of the correction. Please, I would solicit we give me a thumbs up and subscribe to this channel and press the notification bell to do me a turn up. Then lastly, market conditions. Momentum investing can underperform in a sideways or choppy markets where trends are less predictable. As I earlier discussed, this particular strategy, this strategy is strictly a trend-based strategy. You understand? And so, in a market where trends are not visibly or clearly defined, like in the choppy market, it's difficult to perform well. And so, you can only do better with this strategy in a bull market where almost every stock is climbing on a rising trend. You are going to benefit maximally from this particular strategy. When the case where the market is choppy, it's fluctuating, it's not really like it's neither a bull nor a bear market, it's very difficult to benefit or to profit as a momentum investor. So when you want to consider this particular strategy, don't forget to equally look into all these disadvantages and see how you can not only acknowledge them, but see how you can mitigate their impact on your investment performance.